Hi all, welcome to this tutorial. In this tutorial, we are going to cover the leverage, solvency and earning coverage. In the previous discussion, we already discussed about the liquidity. Liquidity means is the ability of a company to meet the short-term liability or short-term current liabilities. But when it comes to solvency, solvency means is the ability of a company to meet its long-term obligations. If you look into balance sheet of a company, you can see two types of liabilities. Normally, it is the current liabilities and the long-term liabilities. For the liquidity, normally dealing with the short-term liability or current liabilities. But when it comes to solvency, solvency is mainly handling with the long-term liquidity or long-term solvency. Solvency ratio measure its ability to meet long-term obligation and survive over a period of time. This assessment is heavily dependent on the firm's capital structure, the mix of debt and the equity used to finance the assets. So as we know, once the company increases the debt, definitely the risk also increasing. And if the company can lower the debt as possible, the same time the risk also lowering. So it will have an effect or impact with the return as well. So the companies normally the company should normally trying to find an optimum level of capital structure or optimum capital structure by optimizing the risk and return. The impact of financial leverage. Financial leverage refer to the use of fixed cost source of fund, typically debt and preferred stock to magnify return to common shareholders. Financial leverage mean is the use of long-term debt or preferred stock to magnify the return of equity shareholders. The benefit of financial leverage is to if the return generated by borrowed fund is higher than the fixed interest cost, the excess return accrues to the common shareholders, increasing return on equity. Just look into a case. If the fixed interest cost is 8%, and if this company can generate a 10% profit by using the same this debt fund or preferred fund, so the balance 2% can be distributed into equity shareholders. So that's a benefit of using financial leverage. Again, there is a risk as well. If the operating risk falls below the fixed interest cost, the use of debt will magnify the loss to common equity shareholders. So if in this case, if the return is 6%, again there is a fixed charge of 8% to that debt capital. So that will create a loss to that return loss will impact the return of common equity shareholders. So when it comes to leverage, there is a benefit and risk as well. So when choosing a debt choice or the fixed financial leverage, the company has to consider all these factors when they are choosing or when they are considering to have a financial leverage. So let's move into capital structure and solvency ratios. The first one is debt equity ratio. This is a fundamental measure of capital structure. It is compare total financing from creditors, that means total liability or total debt, with the total financing by owners, that is shareholders' equity. So you can see the formula for debt equity ratio here, that is total liabilities divided by total shareholders' equity. Total liability means total debt divided by equity. So the interpretation, how we can interpret this ratio, that means if a ratio means 1.5, which means the company uses 1.5 of debt financing for every $1 of equity financing. So let's look into a case. If it is 1500 divided by 1000, in this case the ratio is 1.5. So what it means that this company using $1.5 of debt finance for every $1 of equity financing. That means for every $1 of equity financing, there is an equivalent $1.5 of debt fund in the business. So when it comes to risk profile, again as we discussed before, If higher ratio, that means higher debt mean it indicate greater risk. That means company using more leverage. If the company can generate more revenue or return than the debt cost of debt, it can magnify the return of the equity shareholders. If the worst was or the companies can generate only or able to generate only the lower return than the debt capital, debt cost of debt, then it will have a negative impact in the return of common equity shareholders. You can see example here. The total liability is 40 million and the total equity is 60 million. So in this case, the debt equity ratio is 0.67. That means 40 divided by 60. So what it indicate that this company have $0.67 of debt capital for every $1 of equity capital. So let's move into second ratio, that is long-term debt equity ratio. It is similar to debt equity ratio, but in the long-term debt equity ratio, we are considering only the long-term debt instead of total debt. So as we know, the long-term debt are the debt which has to settle or which have a longer maturity period. So in the total liability or total debt, we are considering all short-term liability as well. But when it comes to long-term debt equity ratio, we are considering only the long-term debt or long-term creditors with a shareholders equity. So we'll move to next ratio, that is debt to total asset ratio. Debt to total asset ratio is a percentage of a company's comparing total liabilities or total debt with the company's total assets. So the interpretation of this ratio, if the ratio is 0.4 or 40%, which means the asset acquired, 40% of the asset were acquired through the debt and the remaining 60% financed by the equity. Just look at case. If in this case it is 400,000 is the total liabilities and 1 million is the total asset, for example. So which means it is 40%. So what it indicates that the 40% of this total asset is financed by the long-term liability or total liability. You can see the same example here. Here it is 40 million and 100 million. So the debt asset equity ratio is 40.4 or 40%. As we said, which indicate that the 40% of the total company's asset is financed by the debt or total liabilities and the remaining 60% is financed through the equity financing or equity capital. So we move to next category of ratio, that is financial and equity multiplier ratios. The first ratio is financial leverage or equity multiplier. The formula for total asset divided by total equity. The equity multiplier is a component of DuPont analysis and measure the degree of to which a company use a debt to finance to its asset. It effectively translates the balance sheet risk into a operating metrics. So you can see the formula here, that is total asset divided by total equity. The interpretation, if an equity multiplier 2 mean the half of the company assets are financed by the debt and half by equity. Just see a case. Here the total asset just assume is 1 million and the total equity is 500,000. So in this case the equity multiplier is 2, which indicate that half of the total company assets is financed by the equity and the rest half is financed by the debt. A higher ratio normally indicates that use of higher debt. Just look into this case. If in this case it is 2 only. Just look into other case. If it is 1 million divided by 750. So in this case it is less than 2 or it is 1.25. If you look into other example, it is 1 million divided by 200. That means high. It is 5. So the debt equity multiplier is higher, which means the more debt is used in the capital structure. If it is lower, which indicate that lower debt is used in the capital structure. We can look into this case. This case, the total assets is 100 million and total equity is 60 million. So the equity multiplier is 1.67. So which show that every $1 of equity, the company support $1.6 of asset and the remaining being to debt. So this 1.67 indicate that every $1 of equity, the company have $1.6 of current asset and the remaining 6.7 is financed through debt. So we'll move to next topic, that is degree of financial leverage. The degree of financial leverage measures the sensitivity of earning per share to changes in earning before interest and tax. So degree of financial leverage is measuring how sensitive the earning per share with changes in the earning before interest and tax. It quantifies the magnification effect of fixed financing cost, or that is interest. So degree of financial leverage is, the formula is percentage change in EPS divided by percentage change in EBIT, or EBIT divided by EBIT minus interest plus preferred dividend. So as an interpretation, the degree of financial leverage 1.5 mean, which indicate that 10% change or 10% change in EBIT can lead to 1.5% or 15% change in the EPS. Just look into this case. In this case, the EBIT, earning before interest and tax, is 5 million and interest expense is 1 million. So the degree of financial leverage is 1.25, which indicate that 1% change in operating income will leads to 1.25% change in EPS or earning per share. This is due to magnification effect of fixed financing cost. Even if we increase the operating income, again the fixed financing cost will remain the same. So this is the magnification effect of fixed financing charges. So degree of financial leverage is measuring how sensitive the EPS or earning per share with related to changes in the operating income or EBI. In the financial leverage, we discuss the use of fixed financing instruments to magnify the effect of earning per share or magnify the effect of net income. But when it's come to operating leverage is the measure how sensitively of EBIT changes to changes in the volume. It quantify how a firm fixed operating costs magnify changes in the sales into changes in EBIT. So it is magnifying, or it is measuring how changes in sales will contribute or affect the changes in the EBIT or earning before interest and tax. So this is measuring the magnification effect of fixed cost or use of more capital assets. The degree of operating leverage, how we can interpret the degree of operating leverage? If the degree of operating leverage is 3, which means the 5% increase in the sales will lead to 15% increase in the EBIT, or 10% change in the sales can lead to 30% change in the EBIT. If the company is with a high fixed cost, will normally have high degree of operating leverage. Again, if you look into fixed cost remain always same if the activity level increase. So the degree of operating leverage measure how this magnification effect work, or how company can leverage or can benefit by using high fixed cost or high capital investments. So let's look into an example. In this case, the sale is 10 million and variable cost is 4 million and fixed cost is 3 million. So here the contribution margin is 6 million, that is sales minus variable cost. And the EBIT is 3 million, that is contribution margin minus total fixed cost. So in this case, the degree of operating leverage is 6 million divided by 3 million. That is 2. So, which indicate that a 10% increase in sales will leads to 20% change in EBIT. So, let's move into next topic, that is degree of total leverage. So, the degree of total leverage is the combine the effect of both operating and financial leverage. Is measuring the total sensitivity of EPS changes in sales volume. The degree of total leverage measure how changes in the sales volume will affect the changes in the EPS or earning per share. So it is considering both effect of company's cost structure or use of fixed cost and its financing structure. So just look into this example. If the degree of operating leverage is 2 and degree of financial leverage is 1.25, so in this case the degree of total leverage is 2.5, that is 2 into 1.25. So which indicate that a 1% change in increase can leads to 2.5% change in the EPS or earning per share. Or we can interpret that 10% change in the sales can leads to 25% change increase in the EPS. So we'll move to next category of ratio, that is earning coverage ratios. Earning coverage ratios measure a company's ability to meet its fixed financial obligation, primarily the interest or the liquid lease payment, by using its recurring income or cash flow. It is measuring how effectively the company can meet its fixed payment or fixed charges by using its operating income. The first ratio is fixed charge coverage ratio. Fixed charge coverage ratio is a comprehensive measure than other ratios which measure all the fixed charges and is comparing with our operating expenses to see how effectively the companies can meet the fixed charges. So the formula is EBIT plus fixed operating lease payment divided by interest expenses plus fixed operating lease payment. So in the interpretation, measure how many times the company's earning can cover its total charges. So that means it is measuring how many times this company can meet its total fixed charges by using its operating income. So let's look into this case. In this case, the EBIT is 5 million and the interest expense is 1 million and the lease payment is 500,000. So here the formula is 5 million is our operating income plus 500,000, that is fixed lease payment, 500,000 divided by total fixed charges, that is interest expense is 1 million plus 500,000, that is lease payment. So here 5.5 million divided by 1.5 million, that is 3.67. So which interpret that this company can meet its total fixed charges 3.6 times by using its operating income. So we'll move to next ratio, that is cash flow to fixed charge ratio. Cash flow to fixed charge ratio is considering the cash flow, how effectively this companies can use its fixed payment, fixed charges by using its total operating cash flow. So the formula is cash flow from operating activities or operating cash flow plus fixed operating lease payment plus tax payments. So the plus divided by interest expenses adding fixed operating lease payments plus tax payment. So here you can see an example. If the cash flow from operating activities is 4.5 million and the lease payment is 500,000 and the interest payment is 1 million and the tax paid is 1.2 million. So in this case, you can apply this number into formula. So the cash flow 4.5 million plus fixed lease payment is 500,000 plus the tax payment is 1.2 million divided by total interest expense plus fixed operating payment plus tax payment. That is 6.2 million divided by 2.7 million. That is 2.3. So which interpret that this company can meet its total fixed payments by using its cash flow 2.3 times. So again, this company can pay the 2.3 times of its total operating expenses or fixed interest expenses or other fixed charges by using its operating cash flow. So let's summarize today's discussion. The first thing what we discuss is capital structure. Capital structure is measuring how the capital, what are the elements of the capital structure or which measure a primary source of financing. Again, there are mainly two sources of capital as there one, the equity and debt capital. If the company is using more debt capital, normally we say that the company is leveraged capital structure, which indicate that the company have higher risk as well as higher risk potential as well. Then the debt to total asset, which indicate the percentage of firm total asset financed by the debt to asset ratio. Then the financial leverage or equity multiplier. There are two types of financial leverage we discussed already, operating leverage and the financial leverage. Then the degree of total leverage, which consider both operating leverage and financial leverage. Then the fixed charge coverage, measure the most critical long-term solvency requirement, the ability to cover all mandatory financial obligation from recurring earnings, EBIT or cash flow. So this is about today's discussion. Again, I am attaching this PDF material with the description, so you can download and refer this material for free. If you have any doubt or you need any other clarification on any of these topics, please ask me on the comment section. Thank you for watching this video.